Welcome to The Explainer. Today we're going to peel back the curtain on how businesses make those huge, multi-million-dollar decisions. How do they really know if a big investment is a brilliant move or, well, a massive mistake? The answer is a process called financial appraisal, and it all kicks off with one simple but actually pretty tricky question.
So let's just dive right in with a question that gets to the absolute heart of this. Is every project that's worth doing actually profitable? I mean, your first instinct might be to say, well, yeah, of course. But the reality? It's a whole lot more complicated than that. So check out this real-world example from our source material. A hospital has to spend 90,000 rupees on fire safety measures. Now, does this project make the hospital any money? Nope. The direct, tangible financial return? It's zero, zilch. But here's the kicker. If they don't do it, they get shut down. This shows you that sometimes the most crucial projects have nothing to do with making a profit. They're about pure survival.
All right, so what about when a project is actually about making money? How do we figure out if it's a good bet? Well, let's start with the method that's probably the most common, the one that's basically everyone's first instinct.
It's called the simple payback method, and the name says it all, really. The whole concept is incredibly straightforward, which is exactly why it's so popular. It answers one very basic, very human question. How long is it going to take to get my money back? To really get a feel for how this works, let's jump into an example right from our source document. So a company decides it's going to invest a pretty hefty sum, £150,000, to upgrade its old, clunky, inefficient heating system. That right there, that's our initial investment. That's our starting point. Now, the cool thing here is the benefit isn't some new product they're selling. It's actually a consistent, predictable saving. The company figures this new system is going to save them £25,000 every single year on fuel and repairs. So you can think of this as the cash inflow that's going to start chipping away at that big initial cost. And you can see the math is super straightforward, right? We start deep in the hole at minus £150,000. But watch what happens. Each year, we add those £25,000 in savings, and that negative number just keeps shrinking. It goes from minus 125 after year 1, all the way down until, bam, at the end of year 6, we finally hit zero. We've broken even. So there we have it, a 6-year payback period. And on the surface, that sounds pretty decent, right? You'd probably approve that project. But, and this is a huge but, this simple little method is hiding a massive, absolutely fatal flaw. We are missing a giant piece of the puzzle. And it all comes down to this one idea, this one principle that just changes the whole game. Money has a time value. A pound in your hand today is worth more than a pound you're promised a year from now. And understanding this, well, this is the secret to thinking like a real professional financial analyst. To really let this sink in, our source material gives us this perfect analogy. Let's call it the rich ant problem. It makes it all crystal clear. All right, play along with me for a second. I want you to imagine you have this super generous, super rich aunt, and she's decided she wants to give you a gift. And we're not talking about a gift cart here. We are talking about a life-changing sum of money, £500,000. Now, here is the catch. She gives you a choice. You can have the money today, this year, or you can wait and get the exact same amount next year. The choice seems totally obvious, right? Of course you want it now, but let's dig into the why of it. It's about more than just being impatient. Okay, look at the numbers. If you get the cash this year, boom, you have £500,000. Easy. But if you have to wait a year, you lose out on a whole year where you could have invested that money. So if we assume you could get, say, a 15% return on it, that £500,000 you get next year is really only worth about $434,000 in today's money. Just by waiting a year, you've effectively lost over $65,000 in potential growth. This whole process, this idea of figuring out what future money is actually worth to us today, has a name. It's called discounted cash flow analysis. And the final number you get, the value of all those future earnings in today's money, is known as the net present value, or NPV for short. All right, so now we've got the professional's toolkit. Let's head back to that office heating project and rerun the numbers, this time accounting for the time value of money. What do you think is going to happen to our nice, simple 6-year payback? Okay, let's break down this table. I know it looks a little complicated, but I promise it's not. We've still got our £25,000 saving each year, but now we apply that discount factor.
we're using 15% again. Just look at how the discounted cash flow gets smaller every single year. That 25 grand saved in year 1, it's really only worth about 21,750 today. By the time you get to year 10, it's only worth about 6,000 pounds. And that makes a huge difference to when we actually break even. And here it is, the knockout punch. That nice, simple 6-year payback period, forget about it. It's gone. Once we factor in the real value of that money over time, the discounted payback period balloons to a staggering 17 years. All of a sudden, this project doesn't look so hot, does it?
Wow, I mean, seeing a 6-year payback just explode into 17 years, that's a huge shift in perspective. So what's the big takeaway here? What are the key lessons we need to pull from all this?
First off, that simple payback method, yeah, it's easy. But man, it can be dangerously misleading because it totally ignores this whole time value of money thing. Second, and this is the golden rule, money you have in your pocket today is always worth more than the promise of money tomorrow. And finally, using a real tool like discounted cash flow analysis gives you a much, much truer picture of a project's real long-term value. It gets you beyond simple guesswork. So the next time you hear about some big, shiny investment that's going to pay for itself in 5 years, you'll know there's a better, smarter question to ask. And that question is, sure, but what's its real value when you account for time? Answering that question, well, that's the difference between just making a guess and making a truly great investment.